Hello, fellow professionals. Dennis Tyler here with Capital Financial Mortgage. I thought you might appreciate, with all of the gyrations in the market right now, a little bit of an interest rate update. And in fact, from now on, I'll be sending regular updates to you, so you'll get those, you'll know where the market is and where it's going. Let me just share with you a few thoughts that I've had as I've watched what's been going on in the marketplace. First off, there's an ongoing war between the bulls and the bears. That war determines where the interest rates are going and what kind of an interest rate your clients are going to be getting. With that said, as you already know, good economic news means that the bears are winning. The bears have a tendency to swipe downward with their paws, and as they do so, mortgage-backed securities go down. Interest rates react exactly opposite of how mortgage-backed securities react. And so here you'll see mortgage-backed securities going down. As a result, interest rates start going up. So whenever you see good economic news, that can be construed as inflationary. Anything inflationary affects the bond market, and as a result, the interest rates will tend to climb higher. On the other hand, bad economic news is good for the bond market, good for interest rates. As the bulls thrust upward with their horns, mortgage-backed securities go up. Again, interest rates react exactly the opposite, and interest rates start heading down. Now, what's the point of all this? Why would I share this with you? Well, first off, a little bit of an explanation. Whenever the market is good, when there's good news, investors investing in securities or bonds will move their money. So market is good, investors aren't too concerned about safety. They go into securities or the stock market. As a result, mortgage interest rates have to go up to compete for those investors and bring their money back into the bond market. On the other hand, when there's bad news, investors flee for the safety of bonds. As a result, there's so many buyers out there for mortgage-backed securities that the interest rates will tend to go down. Now let's take a look at what happened today in today's market. You'll notice first off that there's been a trend downward. So starting right here, we see this trend going down, mortgage-backed securities going down, which remember means that interest rates are going up. Yesterday we had a change in the pattern. We have a hammer formation right here, which is a signal that there may be good news coming. And sure enough, today's news is that we broke through two levels of resistance right here. We broke through the 10-day moving average, and we closed up by about 45 basis points. That's great news. That means that interest rates are heading down, at least temporarily. But let's take a look at what is going on longer term. You'll recall that back here in October of 2008, the federal government announced that they were going to be buying mortgage-backed securities. As a result of their announcement, look what happened right here. Interest rates or mortgage-backed securities just flew upward. Interest rates were down around 6% when the government announced that they were going to start buying $1.25 trillion worth of mortgage-backed securities. Then all of a sudden interest rates went down as these mortgage-backed securities went up. And as a result, we've been trading in this range right here in the 4 3/4, 5% range for quite some time. We got into 5 1/4, 5 1/2 for just a blip period of time. But for the most part, for the last year and a half or so, we've been around that 5% range. Today's interest rate is right at 5%. Where are we heading with this? Well, you can see here that here's a level of support. As we break through this level of support, it's likely that we're going to be dropping down here. Mortgage-backed securities are going to drop, causing interest rates to go back up higher. Why? Well, the biggest reason is that the government has stopped buying mortgage-backed securities as of March 31st. As of March 31st, the buying program has gone away. As a result, the tendency will probably be that we're going to see interest rates get back in this 6% range. It'll take some time for those interest rates to drop back down, or excuse me, for mortgage-backed securities to drop down and for interest rates to get back in this range, but it appears that it's coming. There's going to be quite a few gyrations in the meantime, like a roller coaster ride. So what's up ahead? Well, as the bears and the bulls face off, my projection is that the bears are going to get the upper hand, and we're going to indeed see the interest rates rise, probably to around 6% by the end of this year. What does that mean to your clients? Well, first off, your clients need to know that now is indeed the time to buy, but they don't need to panic. There will be some gyrations in the market still. Now is the time for you to take action. My job is to help you get your buyers off the fence. My job is to assist you in getting more buyer leads. My job is to help provide solutions for your sellers, especially as their appraisals come in low or as they get lowball offers. How can we put those deals together? I have solutions. My job is to help you close your transactions on time, professionally. So what's the next step? Well, give me a call. Let's set up a time for us to get together. I'll show you some of the tools that I have available that can help you get more listings, close more buyer transactions, obtain more good quality leads, and now more than ever, help work as a team. We have to work as a team right now. So give me a call, Dennis Tyler, over at 253-854-5000.